Well, good afternoon and welcome back to our Achieving More Together Today virtual webinar series. This is Blair Marvin, Vice President of the Augusta Metro Chamber of Commerce. Thank you all for joining us and being with us today. We appreciate your time and trust that everyone is doing well. As you know, probably by now, we are doing Tuesday and Thursday webinars at 3 o'clock. An effort to keep our members informed, engaged, encouraged, and just connected to resources and to one another during this primarily virtual time. We also, as part of this holistic initiative, have communicated daily pertinent information on relevant topics, experts that are sharing resources at this time. So those are delivered via email as well as social posts. And you can always reference our website for a recording of past webinars and all of the email communications that have been sent over the last 8 weeks. We are really pleased to have Tom Blanchard and Dennis Trotter join us today on the webinar. Both are members of our executive board of directors, and Tom is the president of Blanchard and Calhoun Real Estate. Dennis Trotter represents partner of Jordan Trotter Commercial Real Estate. And so they are going to bring us some enlightening information on the latest trends regarding our region's commercial and residential market and what to expect as much as can be determined at this time into the future as we move into a period of recovery. So Tom, Dennis, thanks for joining us. Thanks for all you do for our board and our community. And I am turning it over. Before I do, real quickly, of course, a reminder that you can ask questions via our question button of the GoToMeeting GoToWebinar application. If you'll submit those at any time during the webinar, we'll have a short period of Q&A at the end. And of course, the recorded webinar will be sent out via email to those that registered tomorrow, as well as, like I said, hosted on the website. So without further ado, Tom and Dennis, thanks so much.
Thank you, Blair.
Yeah, thanks for putting it on.
We really do appreciate it. Hope we can be some give you some informative information. Real quickly, obviously, I'm Tom Blanchard with Blanchard and Calhoun Real Estate Company. We are a locally owned real estate company. We have been in business for over 100 years. We're in the real estate, mortgage, and the insurance business. Have been in all of those businesses, obviously, since our founding in 1919, and continue to do that to this very day. We sell, we lease, we manage, we develop more commercial and residential real estate. We do mortgages for home buyers, and obviously we're in the insurance business for homeowners and autos and commercial and property lines. And I'm here today on behalf of our real estate company to talk a lot about the residential housing market. In our real estate company, we are about 30 employees. We've got about 180 agents. We sell about $450 million worth of homes. That's what we did last year in 2019. We manage 1,500 plus apartments and houses in the marketplace, and are active in the development of our area residentially and commercially also. So that's just a quick snippet of who we are. Dennis, how about you?
Thanks, Tom. Yeah, our firm, Jordan Trotter Commercial Real Estate, we started in early 2013, and of commercial properties of all types for conventional brokerage, property management, and development around the CSRA and out into the Southeast as well. So I will preface everything I tell you today with I know very little about the residential real estate world, and it's probably better that way. And what we're seeing going on in the market right now is uncharted waters for all of us. It is changing by the day, if not by the hour, especially as we start to see some of the retailer bankruptcies start trickling in this week, and we'll expect to see more. And so we are the rules of the game. We have no rules for the game that we're involved in right now. We're I hate to say we're making it up as we go. We're not, but there's no playbook to go off of, such as we had, in the 2008 recession or 2009 recession, where we could go back and look at historical trends. We've never had a pandemic like this that shut the economy down. So it's all hands on deck to study and learn and follow our peers around the country and what they're doing for both landlords, tenants, building owners, multi-location unit operators, and try to pull everybody in the boat together to figure out the best path forward. There's nobody that hasn't been affected by this in some manner.
Well, I'll get us started, and I'll cover the residential housing marketplace first, and then I'm going to let Dennis obviously touch on the commercial sector. I by no means have a crystal ball. I'm with Dennis. I cannot predict what the future is going to hold for us here. I will tell you, just like he did, we are all in sort of unprecedented times in this environment. We have seen housing crises before. We have seen housing crises before, obviously, in our company and in this marketplace. So we've been through these type things before, but I'll get back to what he kind of emphasized, and that is we don't really know what the future is going to hold. It is taking a lot of networking. It's taking a lot of communication, and each day is bringing on something new for us. So what I thought I'd cover today was a little bit about where we were, and then talk about where we are, and I'll do my best to kind of talk about what we think may be coming to some degree, and try to keep that short and sweet. I'll try to educate you a little bit on some of these terms and terminologies as I go through this, and hopefully it'll be helpful for you. So entering 2020, Augusta probably was coming off one of the best housing years it had ever seen. Our marketplace is in what we call a seller's market, and National Association of Realtors, which is where we derive a lot of our information from, defines markets as a seller's market, a balanced market, and a buyer's market. A seller's market is when your inventory levels are at certain numbers or certain statistics that there are more buyers than there are sellers, i.e. the seller's market. A balanced market is when you have a good balance of both of those, and then obviously a buyer's market is when there's a lot of inventory and the buyers are at more of the advantage in selecting their product. Augusta's been in a seller's market for probably the last 2 years, maybe a little bit longer than that. I don't quite have those physical statistics in front of me, but I can tell you in the last couple of years, we have seen a continuing decline in inventory levels, a continuing demand for the housing, and continuing growth in our marketplace. And so our market was entering what we thought was going to be one of the best years in the housing business that we'd seen in a long time, not much different than most other national industries and across the nation as the economy seemed to be thriving. And that is all in new homes and in existing homes. We look at both of those as we study what the housing market is. We really define that seller's market by something called an absorption rate. An absorption rate is basically the number of months it would take to sell the homes that are currently listed for sale if no other homes were put on the market at that time frame. And we just finished running some absorption rates for our marketplace here locally. We do it in the CSRA. We break it down by county, and I'll give you a few of those numbers. For instance, our existing houses that are not new, existing houses that are for sale in our marketplace, we're at a 1.8 month supply of inventory in the CSRA at the end of April right now. In new houses, there is a 3.4 months supply of inventory for sale in our marketplace. When you look at Richmond County specifically, and I am deriving all of this information and all of these statistics out of something called the multiple listing service. It is a service that most realtors use in our marketplace. Our marketplace is made up of about 1,600 realtors, 170 plus companies. We take this data and pull it out of there and put it into this format. So I will do one of my disclosures, and that is that information is deemed accurate but subject to verification, because as Dennis said, information is changing every day. MLS has got a lot of product moving through it, and so you have to verify these numbers. Richmond County at the end of April had a 1.7 month supply of inventory in the existing housing sales. It had a 3.1 month supply of new construction houses for sale in the marketplace. So all of those numbers are below what the National Association of Realtors calls a balanced market. It is absolutely a seller's market. What has been a seller's market. Our marketplace started the beginning of the year in the first quarter in a very strong way. Our local housing market has always been somewhat seasonal. First quarters have traditionally been slower. Second and third quarters are primarily when we do most of our housing sales. Fourth quarters always somewhat robust, but traditionally the second and third quarter have been the busiest historically for us. And so our first quarter was the best quarter the marketplace has ever seen statistically, at least as far as some of my numbers went back 6 or 7 years. And so we were really starting off with a bang. I think the math was we had done $50 million more worth of housing sales in the MLS at the end of March than we had this time last year. And so obviously sales prices were up in that arena. Price appreciation, which is if your house is worth something more today than it was yesterday, has been something in our marketplace that has been very fundamental. And we have seen our pricing appreciate year over year the last few years, and absolutely optimistic that we were going to see that again this year. Once April came and this COVID-19 pandemic happened, obviously a lot of that momentum and some of that optimism has changed a little bit. I'll give you some numbers specifically. Last year in March in 2019, we sold 698 units in our MLS houses. That's only houses. This year in March of 2020, we've sold 696. So it's about the same. It's relatively flat. In April of last year, we sold 618 units in the month of April. April of this year, we've sold 592. We're only off about 4% in that arena, which is a great statistic as I read a lot of the other national trends and compare our marketplace to some other ones across the country. Another thing I track and I look at is new listings. And obviously, we do a lot of this tracking of data annually. We do it quarterly, but obviously the last few months we've been watching it weekly and sometimes daily to try to figure out where the market is heading in that arena. So April last year, we sold 618 units. April of this year, we sold 592. I look at how many listings we put on the market. A listing is a house that we sell. That is our product. That is our inventory levels. Last year, we put 894 units on the market in the month of April. This year, we put 644 units on the market. So that is a drop of 28% in a month compared to where we were this time last year. We do think some of those trends will continue in the listing arena, where we do see some hesitation of folks who are a little reluctant to try to sell their house in today's environment. We were actually going into this market, as I tried to say, with a little bit of a supply and demand problem to begin with. I'll give you a national number in that arena very quickly. I think annually, National Association of Realtors used to quote that we formed 1.9 million households every year. I think last year we were building 1.3, which means we were entering it as a deficit. We were forming more households than we were building houses to meet those needs. And I think our market locally is no different than that. I think our inventory levels are down. We're down, and our demand from the community was higher than some of the supply. We saw a lot of multiple offers. We saw certain properties in extremely high demand in list times and times it takes to sell. Like I told you, sometimes at 1.8 months, and then some price points lower than that, where it didn't take your houses long to sell. Our last few weeks have shown us some interesting numbers and that is that we have been writing, we started the month of April with 1,716 listings in the market. Of those, 1,176 of them were existing, and 540 of them were new houses. At the beginning of May, we had 1,545 units for sale. So our market absorbed almost 200 units in the month of April for home units for sale. And of the 1,545 for sale at the beginning of May, 1,000 of them were existing, and 494 of them were new homes. You saw more absorption in new homes to some degree in the month of April than you did in existing homes in the month of April. And we don't know why, but a lot of us think that it's because existing houses and the reluctance and the COVID-19 and the pandemic hitting, and it's a lot easier. It was easier to show a new home. Probably the environment was simpler to get in and get out of. Obviously, when this pandemic hit, our marketplace, along with our industry, along with all the realtors, Dennis included, we all had to adjust very quickly from our traditional ways of doing our business. We're very fortunate. We've all gone to basically working remotely. Real estate's been blessed with a lot of good technology. We've got a lot of good technology. We've been able to continue to do our business as realtors in our marketplace. We did make some adaptations. We're doing virtual showings. Open houses are doing things differently. We're seeing obviously a lot of CDC guidelines and practices put into place. Sanitation, cleaning and sanitation was obviously increased. We're seeing homeowners open all their cabinet doors, closet doors, and drawers so that the possible home buyer doesn't have to touch anything as they enter the houses. And there really have been a lot of great extra precautions that we as a sales force here and quite frankly in the marketplace have taken on. We were fortunate to be deemed essential. All of our businesses have been fortunate to be deemed essential, so we're continuing to be able to work in that arena. A lot of e-signature platforms, document management platforms. The governor allowed e-notaries, which helped us in closings and in the mortgage lending process. And so we did a lot of quick adjusting as we continue to do. Like Dennis alluded to, we're having to each day. We're all learning something new and trying to figure out what it will take to continue to get those transactions moving. But we really have seen a great first quarter in our marketplace. We really saw a great month in the month of April, quite frankly, from pendings and closings. We are seeing some inventory, less inventory come on the market at a lower rate than we did last year. And obviously, last year being a seller's market, we don't see that necessarily changing, at least right now, although moving in the future, we think we do see some headwinds, and we obviously anticipate slower second and third quarters as it relates to housing sales in that arena. Fundamentally, though, housing was really the last cause of the financial crisis. It got really the blame, and a lot of that had to do with a lot of mortgage practices and a lot of more lax requirements that industry saw. We're in the mortgage business. We are not seeing any lax mortgage requirements. We quite frankly have seen more restrictive mortgage requirements. Obviously, rates where they are incredibly low. That is a huge fundamental of what helps our housing market. And we're still blessed with a great local marketplace. We're very optimistic with the Cyber Command continuing to open later this year. The announcement last week of a fulfillment center from Amazon. Our great large corporations that are here that seem to continue to be doing businesses gives us great optimism that the housing market's going to continue in some form or fashion. We don't think it will continue at the rate in the near term. Someone asked me today what I think that recovery will look like in housing. Most recoveries, as we look back on some of the housing crises, have never been quick in a V shape. They've always taken some time, months, if not a year or so, to transition out of. I'm not sure that'll be any different here. Although again, I cannot see the future and have no guarantees on any of that. I'll also touch a little bit on our rental business and our management business as it relates to the residential industry too. We were seeing growth in terms of our housing units and people wanting to put houses on the market for rent. We were seeing growth in investors buying houses to buy as investment properties for rent. And so our book of business has grown, and our marketplace, quite frankly, had seen rental rate increases the last few years, which made it so attractive for folks who wanted to own rental properties to invest in that arena. So those are all what was happening before this pandemic came. We are obviously still continuing to lease houses. We're continuing to get people in and out of those, and probably doing a lot what Dennis will talk about, and that's having a lot of conversations with owners and tenants, and trying to help guide through some of those logistics where we do have some of those challenges. We're not immune in this marketplace to any of the national problems. We do have some of those. We're seeing some of those today, as a matter of fact. But most folks are sitting down and they're optimistic, and fortunately our numbers aren't as large as what I'm hearing some other companies and other parts of the industries are in terms of rental challenges or payment challenges in that arena. But we know we won't be immune to those, but we're optimistic that the fundamentals are strong here, and the rent rates are fairly affordable, and that we will be okay as we come through this. So in a very quick summary, that's a little bit of information on the housing market. And what I really want to emphasize is that we really don't know what our second and our third quarter, and some degree our fourth quarter, are going to look like. We are remaining optimistic about that, and are hopeful that our momentum that we started the year with, our supply and demand levels, will help us position us to go through what we think are some of these headwinds coming in a much more robust fashion, and hopefully the least disruptive to all. We see the value of a home in someone's home, or someone's, quite frankly, someone's shelter, has never been more important than it ever has been. And we don't think that'll ever go away. We're seeing that. We may see that get stronger. We may, and we're going to adapt where we can here at Blanchard and Calhoun. Hopefully keep all of you informed on whatever we know, and hopefully continue to see this area prosper and recover, and most importantly, grow. How about it, Dennis?
Great, thanks, Tom. And so our update today is a little more tailored towards the trends we see coming, because the market we're in now with our shopping centers, office buildings, warehouses is such such new territory for all of us. We see that the pandemic has really separated and is separating the winners from the losers in an accelerated fashion. And the restaurants and the retailers who had invested into their apps, their delivery services, their online ordering, their takeout services, they're doing just fine. Sales are a little down, but they're surviving. The ones who had not made those investments, who were lagging behind, the retailers, the traditional brick and mortar retailers that had not made the e-commerce investments, they're lagging. And so we see this divide and this schism building between the behemoths like Walmart, Costco, Kroger, and the like, with Amazon included, and then some of your older retailers, Sears, J. Crew, and Taylor, some of the sporting goods operators, where they are struggling mightily right now. And so those trends were already in place. The pandemic has accelerated the division of those right now. And so we're starting to see our first round of retailer bankruptcies really trickle in this week with J. Crew, made an announcement for Chapter 11. There's several other name brands y'all all recognize on the watch list for bankruptcy coming up, including J.C. Penney, Neiman Marcus, Sears for a second bankruptcy filing potentially. David's Bridal, as you can imagine, nobody's getting married in a traditional format these days. Ann Taylor, Loft, Joseph A. Bank, Men's Warehouse. They were struggling before under massive debt loads, and now with store closures and no demand, it's just accelerated what is probably inevitable for a lot of them. But as we move through the other sectors, retail and restaurants have been hit the hardest, obviously, and I'll come back to those, but I wanted to touch on some of the other important sectors in the market and some of the trends we see coming that are already really in effect. But in the office world, a lot of major employers had been experimenting with work at home scenarios, some with success, some without. Some liked the idea, some tried it and reverted back and said, no, we need to get everybody in-house again. But the pandemic has forced everybody into a work from home scenario for a lot of people. And that means investing in the technology for them to do it, the work schedule, how do you manage those people that are working at home when you can't see them every single day? And, we've gone quickly from about 4% of our workforce that are able to work from home do it. Now we're at 34% overnight. And so when the restrictions are being rolled back as they are, we're starting to see that 34% will not go back to the 4% we had at the start of 2020. It will the work from home trend will continue for sure, as employers have been forced to figure it out instead of slowly figuring it out. Now they have to. And so, we see trends already of employers talking about requiring new employees to work in the office. And once they reach certain milestones, they're eligible to go home. We see trends of employees investing money in their homes to convert unused space in their houses to home office environments where they can beef up their internet, where they've got fiber in their neighborhood now, where they've got scanners, they've got the equipment they need. And we'll see more and more of that trend for sure. So it creates a bit of a conflicting issue in the workplace, which is, the work from home trend reduces the need for office space and office square footage, yet the people that have that office square footage, then people in there are having to adjust the layouts because of social distancing, throwing everybody into a sea of cubicles in a large bullpen area that was the popular thing the last few years is not so popular in the current environment. You don't want to be sitting on top of your coworker all day long every day. And so that is, as we're constricting with work from home initiatives, we're also going to see some expansion for people going back into private offices instead of cubes, separating their cubes, spreading people out from the way they previously had it, and enlarging their footprint in some scenarios. So those two factors will be conflicting. You'll see the co-working space has been very popular starting 7 or 8 years ago. It has tailed off the last couple of years, and this pandemic will really tail it off for the foreseeable future as communal workspaces and communal break rooms, communal meeting rooms, and sitting in a row of desks next to almost strangers in these communal workplaces is going to be tough to accomplish for these folks in the middle of the pandemic and social distancing. So we think that trend is going to continue as well. But our office market overall in Augusta is still very good, just due to our macro factors of cyber, the hospitals, the growth that's coming here, and our market as a whole is doing well. So while people's space needs might change up and down in this situation, the overall market will stay good. On the industrial side and warehouse side, folks, obviously everybody in the e-commerce business has had a good run the last few months, and so that warehousing need will pick up and continue to stay strong. Our vacancy rates in town are still very, very low in the warehouse sector, and we see that continuing on as everybody's, people's buying habits have been shoved further towards e-commerce and away from brick and mortar at an even faster pace here the last few weeks. And so we'll see. You've already seen it with Amazon making an announcement. They were coming before the pandemic hit, but it's a testament to the market as a whole that they see it as a big enough region in Georgia to support a fulfillment center of that size. Great for Columbia County, great for our whole region. And, the site selectors for industrial projects like that, are not a whole lot different than selecting sites for fast food restaurants. If you see a Chick-fil-A, it's a great site, and it's a good chance you want to locate close by to it. If you see an Amazon fulfillment center, obviously Amazon knows how to do their homework, and they'll draw and attract a lot of other complementary businesses as well on the warehouse and the e-commerce side, especially because we've demonstrated we've got the workforce that can absorb those jobs and retain those jobs. So those e-commerce retailers are competing with fundamentally with Kroger, Publix, Dollar General, the brick and mortar for the last mile right now, and that this pandemic is really shining a light on that. So when you need another roll of toilet paper, you can pull into the brick and mortar and have it within a couple hours or a few minutes, or you can order on Amazon and have it the next day. Amazon and some of their complementary businesses are competing to take that 1 day time frame down to hours and see same day delivery, so they can further close the gap between the ability to go to a brick and mortar store and pick something up and having to wait a day or two to have it delivered to your house. And so that will continue to make drive the need for the industrial space. So the industrial side is not all doom and gloom like some of the others. In the hotel and apartment business, Tom touched on the apartments. So far, April apartment rent collections across the country, and specifically in Augusta, were only a fraction off of prior months. May rent is due now. We'll see some stats on that very soon, but our apartment market is still very strong. There's numerous projects that have come out of the ground in the last 3 years and are delivering units now, more on the way. And that trend is overarching on top of the pandemic. That trend is a function of the job growth we've got in the market, the overall growth of the market, the change in demand for away from single family homes and into apartments by certain demographic groups. And so the pandemic will harden a lot of those opinions on those apartments, as specifically we think for millennials. Everybody likes to talk and write about millennials, and the millennials came into the job market in the worst time in 2008, 9, and 10, and 11, and their struggles in that job market formed their opinion in a lot of ways of our economy and their work habits and what should be happening. Well, those millennials are now moving through the workforce and starting to, with bigger titles, bigger roles, larger pay scales, and getting back into single family home purchases and expanding their footprint. And here they are to get socked with the pandemic and get hit again by a really unusual economic event here. And so all that adds up to they will continue to love apartments. And our market needs to continue to churn out those apartment complexes in a Class A manner and a Class B manner that we can fill up with rising rent levels and great occupancy. So we certainly see more of that ahead. Turning to probably the craziest and the most changing environment is the retail and the restaurants. And like I said, we're separating the good and the bad through this time period right now. I touched on the bad with a lot of, especially the clothing retailers that were struggling before, that some of this will push them over the edge, unfortunately. But with the restaurants, it has really been fascinating to see the distinction between different restaurant operators and who has innovated in this short amount of time to keep their business afloat and even prosper, and who has not, and is just is stuck and not reopening. So the governor obviously has let the restaurants reopen. We have not seen yet all our local restaurants, or even the states that have opened them up, reopen yet. They've gotten very good at takeout, very good at online, very good at delivery, very good at curbside service because they've been forced to. And now the task of reopening a dining room, at a 25 or a 30 or 40% capacity is kind of unappealing for several reasons. Their model doesn't work if their dining room is only 25% full. The staffing levels don't work. And unfortunately, a lot of these service workers that they had are now receiving the unemployment benefits, the federal benefits, and are making far more money collecting that check than they were going to make in their prior occupation. And so that program will continue on into the summer. And so even though we see restaurants opening back up, we won't see a full-scale reopening until later into the summer, if not into the early fall. The interesting stats behind what's happening here now is what we're seeing is while the governments are releasing the restrictions, allowing folks to reopen, the question is who is actually going to these businesses. You might be able to reopen, but if nobody's coming in the door, it still doesn't do you much good. A recent CoreSite survey I'm gonna cite for, which was really compelling, I think, is a survey of the places that the American public will want to avoid after the lockdown. And the top 3 places they want to avoid after the lockdown are anything that involves travel, shopping centers, and movie theaters. And so 68% of the public say they want to avoid all travel after the lockdown. 45 and 44% say they're going to avoid all shopping centers and all movie theaters after the lockdown. Food and drink is at 37% and gyms are at 31%. So 31% of the public say they're not going back to the gym after the lockdown is over. And so those percentages and opinions are not going to change overnight. They're only going to change over a longer period of time. And so while, the gym can reopen in a limited fashion, getting those members to come back in, reinstate their dues, and start using it again is something that is going to be a slow, hopefully gradual, but a slow climb back for those folks. Same with the retail and the restaurant as they try to restore the sales volume that we're generating up into March. It certainly is not going to happen in May. It's not going to happen in June. It's going to be a longer and slower climb back to the levels they're used to. And so how they manage that with their staffing, with their capital, and get it back to where they were, or do they get it back to where they were, or just change their model altogether, or some of the things we're waiting to see how that all transpires. So on top of that poll, there's another one very similar that talks about the U.S. consumers who feel safe or very safe in shopping areas. And there's only about a third of the U.S. consumers that say they feel safe inside of a department store, a shopping mall, or a local small business. Only half the consumers feel safe inside a grocery store or a drugstore chain or a big box wholesaler such as Costco or Sam's. And so that does not bode particularly well in the short term for restoring these folks' sales volumes back to the more traditional level. And so long term, we believe it will come back. It's just like Tom said, we're not going to recover near as fast as we crashed, unfortunately, it appears. But those are national trends. They're very applicable in Augusta. However, we've got a lot of macroeconomic indicators in Augusta that will help us recover faster than anybody else will. Another shout out to all of our state, local, and federal leaders who have worked so hard to have the light shine onto Augusta for the growth of the fort, growth of cyber, the growth of the hospitals, the cancer centers, all that. We are really, really grateful because those provide the employer drivers that we need to keep everybody paid, expand the payroll, expand the job base. All those people are going to live in a house somewhere or an apartment somewhere. All those people have to still get a haircut. They're going to get their nails done, and they got to buy groceries no matter what. And so the form in which they do that and the timeline in which they do that is evolving. But as the market continues to grow, the need for that stuff will continue to grow as well. As far as y'all read and heard a lot, I'm sure, about rent collections during the pandemic, and we're seeing some staggering numbers come in from retailers that have unable to pay any rent at all in an effort to stay even a little bit solvent through the situation. We're seeing mom and pops that have continued to fulfill their rent obligations with some help. We're seeing rent deferrals. We're seeing rent forgiveness. We're seeing some really creative deals for the mom and pops, the small operators, and the smaller scale folks. And we've seen ourselves and our landlords be as creative as the tenants can be in helping them out, because obviously a vacancy at this point doesn't do anybody any good. And our lenders have been cooperative, and it is imperative that the faster we can help them both stay open, get their employees rehired, and get their sales volumes up to where they need to be, the faster we can restore rent back to the expected levels, to make the landlords whole, the lenders whole, and keep the investment business sound in those property sectors. But unfortunately, and similar to 2008, 9, and 10, we still have a lot of regional and national retailers who have seen this as somewhat of an opportunistic event to demand rent relief and force their landlords into rent relief, whether it's warranted or not. And so each rent relief request gets evaluated on a case-by-case basis. Those that truly need it get it the most and get it the quickest, and those that don't are handled in a separate manner. And so we see those still coming in from all sides, all sectors, all types of retail, all types of restaurants. And again, for the most part, the mom and pops have been incredibly great to deal with and transparent, and they get the most help from their landlords, from their food suppliers, from all their vendors across the board to keep them open and preserve the ability for them to reopen in full just as fast as they possibly can. So that's a lot of trend lines. Again, we're all blessed, Tom, too, by having a great market to operate within. And as long as those macro indicators of our economy stay strong, which we all believe they will, we'll pull through this in a relatively short amount of time and get it back to as normal as we can. The look of your favorite shopping center might not be the same when we come back, but it will still be there. And like I said, people still want to get out. You can't get a haircut online yet, and you can't get your nails done online. And so we're going to support all those brick and mortar businesses as best we can, especially the mom and pops.
I wish I could get my hair online.
Yeah, that's right.
All right. Well, thank you all so much for the information and the expertise that you've shared with us today. We really appreciate your knowledge. And we do have a couple of questions. So, Tom, if you don't mind, I'll kind of take over from here with asking the questions. The first one is for you. The military recently extended their stop movement to June 30th. Will the market be ready when it is lifted? Get your crystal ball out.
From a workforce perspective, I guess, from the agent's perspective, the closing attorneys, the appraisers, the inspectors, really the industry behind the housing business, we're all still open and we're all still operational. We're actually seeing some of those transferees and folks who, while maybe under a no-move policy, choose to continue to buy their home. We're seeing those things done remotely. We're seeing power of attorneys. We're seeing we're seeing a lot of our local vendors and local suppliers of the services that are required collaborate, take the necessary steps it will take to make sure that when that does happen, that we can get back to normal as quickly as we possibly can. So we really haven't seen, again, we're seeing transactions being done in lawyers' offices, deeds are being recorded, lenders are loaning the monies are getting funded, all the documents are being done, they may be done electronically. It might take a little bit longer than it used to, but all of those transactions are still happening. And quite frankly, we're looking forward to that day, maybe when they lift that order and the door opens a little bit, because I think we'll all be ready for them when they come, and we'll welcome them with open arms and hopefully move them into our marketplace. Hope that answered your question there, Blair.
Yeah, it's great. Thank you. I have one for Dennis, if that was all on that.
I've got a question for Dennis. This one's for you, Dennis. Can you speak to the demand for downtown apartments and the range of rental rates that you are seeing and expect from new downtown residential developments? You need a crystal ball.
Yeah, you need a crystal ball for that one. So the existing inventory that's down there, occupancy is still great. Rents are certainly going up. We haven't had a full, Class A amenitized apartment development hit downtown yet to really solidify what a true market rent is for a Class A unit in downtown, aside from Canal Side apartments across from University Hospital and the apartments at the ballpark over in North Augusta are really the closest things. And so it will, all the demand factors are there for that rent to continue to escalate up. We also see, but as that happens, the expenses associated with operating those complexes continue to rise too. The county's going through a countywide tax reassessment of all the multifamily in town. We expect some tax hikes on those. The cost of utilities and services and trash and cleaning all continue to rise, and so it is a somewhat natural thing for those rents to continue to rise in an incremental level. We will, if we can get one good Class A project of 50 or more units downtown, new construction, to set a real bar for something in the middle of the downtown district. And I know there's several in the works. That'd be great, and would I think unlock a lot of other projects to come along as well.
That's a great answer. One thing you and I both can attest to is the cost of construction and the cost of delivery from even the land to the finished unit product. Doesn't matter whether it's necessarily commercial or even a house in a residential subdivision. Those costs have crept up higher than I think any of us had ever seen locally, but that was also driving higher rents and higher price appreciations. And I'm not sure if there'll be changes in those cost structures that can be helpful and more incentive, or it can be more challenging to get back to those levels. But obviously, apartments and that growth, you hit on it. I think our market has seen more planned units in Richland County than we've seen in the last few years. And that got into the demographic, affordability, and a lot of factors were in on that. And so I think cost of construction has a lot to play in. Has some strain to here too.
No question.
All right, if I may, I have one more question. Dennis, how should I interact with my landlord on my commercial space for rent relief or assistance?
Wow. So we get that question more than I thought we ever would. And we're having to have conversations that I thought we never would ever have to have with our tenants and landlords in these times. And so, we see very, very few landlords that take a hardline stance of no, there is no assistance available, period, pay the rent or get out. There's a very, very few of those. The way more common approach is, yes, for that tenant, they need to assemble and try to, if they can illustrate with their own empirical data, the drop in sales, the drop in activity from their, March and April and early May numbers for 2020 versus what they've experienced in 2018, 2019, and show the decline there. That's one step. The second step is, illustrating to that landlord that it really is imperative to have it for the continued operation of the business. And while, you might have enough money to pay your May rent or your April rent, your sales in June, July, and August, likely are not going to be where you back where you want them to be. And so it's about helping that tenant find some stability, not just for a month or two, for the duration of the shutdown, but really to weather through the economic storm in general as they get back up. And so we're all very lucky to have a master's date on the calendar in November that will really help a lot of hotels and restaurants make up what they lost in April. Masters is the 13th month for all those folks, and the loss of that even without the pandemic, is a crushing blow to them, but on top of the pandemic is really difficult. And so we need that event to go on, obviously, and not be canceled or postponed further. And that will certainly help. But yeah, the best policy usually on negotiating or asking for any rent relief is total transparency with your with your landlord. I think there's very few that will take the stance of no relief no matter what. And the more the applications and the discussions that roll through our office, the more supporting data and the more transparency we see, the faster they get dealt with and in a cooperative fashion.
Great, thank you. So I have a question for both of you to weigh in on, and this comes from an investor of residential real estate in Augusta. He or she states, I feel it's best to wait 6 to 12 months to wait out the uncertainty of the times to hopefully find a lower price. Would you agree? 20%, which is an outstanding and not mentioned at all in this webinar, 20% unemployment usually lends itself to defaults on loans or low demand to buy a home. Would you guys agree with my thinking?
Yes, I think eventually somebody's employment situation will obviously absolutely factor into their housing situation, which could factor into somebody's potential valuation. And it could absolutely affect a marketplace evaluation in that arena. You know, that there are national trends that are predicting the largest amount of mortgage defaults and the largest amount of people not making mortgage payments in the history. Today, we haven't seen that. Like I'm talking in the housing business today. Again, I don't know what the future is going to hold. Obviously, more inventory that gets put on the market for people's certain circumstances and individual situations, which could be unemployment, may drive more housing. More housing may drive less price appreciation. It could bring prices down. There are factors that weigh. Some of that could be area specific. Some of that could be product specific in that arena. So the possibility of waiting that out is a very viable one to think about. That's my answer to that question.
Time will tell. Right now, we've got sellers who think their property is worth what it was on March 1st, and maybe they're right, maybe they're wrong. We have buyers that think it's worth a giant discount to that, and maybe they're right, maybe they're wrong. And right now, we have a lot of stagnation and stalemate because there's this perceived need for a discount that sellers don't want to give and buyers want to take. Well, somebody's going to win that fight, and we don't know yet who it is. Time will tell if the sellers are wrong and these properties do drop in value because of other reasons, or if the sellers were right and the buyers are going to have to go back to where they were paying. And so at the time, in the current situation today, May the 5th, it's a lot of stalemate because we just don't really know. As time marches on, employment starts creeping back up, stay-at-home orders are lifted, what the general attitude of, normally motivated buyers and sellers will continue to evolve. And so, uncertainty creates instability and creates these discounts. And we see certain property types where that's coming, but not necessarily across the board.
Thank you both. I have one final question, if I may, time allotting. In regards to these transactions, and I assume this would apply to commercial and residential, the question being posed is, can either party terminate the contract based on anything related to COVID-19, such as illness, exposure, and quarantine, excuse me?
That's you, Tom.
I'll answer that one from the residential end. I have not seen, I've seen some requests for terminations. I've seen more addendums to time extensions, instead of canceling. I've seen a lot of, let me extend the time frame for closing until we can get our lives back in balance, or some of that. Um, but we have seen some folks who have felt like they're uncomfortable moving forward based upon the current environment. We obviously, each contract has its terms and conditions laid out very clearly in those contracts. That is, all contracts are between two parties, obviously, and any change in those has to be agreed upon by everybody. And we've seen a few of those circumstances, and fortunately, they've all been agreed to, and we've been able to work all those out. And everybody's walked away happy. Fortunately, the sellers have put their houses back on the market, and we've been able to resell them. So it hasn't necessarily been too much of a problem there. What the future will hold in that, I don't know. We're approaching those as those situations come up. We haven't seen exactly a large percent of any of that from a default or a contractual issue perspective. Yeah.
So Tom's right. We have all these fancy leases and fancy sales contracts written by fancy people that make a lot of money, and all those documents flying all over the place. I have yet to see a single one that uses the word pandemic. Nobody ever thought to use the word pandemic in these contracts to itemize a reason for a delay, an excusable delay. They talk about acts of God, strikes, lockouts, things like that, shutdown of the banks, but nobody ever thought to use the word pandemic when all these contracts are being generated. And so when a buyer shows up and says, well, I'm not closing because of the pandemic, well, that's not a legitimate reason in your contract not to close, but we're all sympathetic to it. But it ignites a new discussion between all the parties on how are we going to handle this. And so going forward, when y'all buy and sell or lease anything, I'm sure you will see the word pandemic probably in bold letters, because we won't make this mistake again. And we'll all learn from this for sure. And it'll be a section of that contract that everybody starts to pay attention to instead of one that everybody glosses over. And so it's created some additional work, and as buyers and sellers need to do different things to get these things closed out.
But, fortunately, that's what Dennis and I are here for, is the agents, the intermediaries in that arena, and that's our job, to help guide through those processes.
Great. Well, thank you both so much for your time, Tom and Dennis. We really appreciate, again, your expertise and the value that you bring. We will, again, be sending the recording of this webinar out tomorrow to all those registered, as well as contact information for Dennis Trotter and Tom Blanchard. If you have further questions, you can feel free to reach out to Sarah Best, our Director of Events, or myself as Chamber staff, or to Dennis and Tom, respectively, from the information we'll provide. And again, the webinar, along with all of our past webinars, will be hosted on our website for your reference, review, or for you to share with those you think might also value or benefit from the information. So we hope to see you all Thursday at 3. We will have Dr. Mark Newton giving a presentation on the testing mechanisms and different options to allow return to work policies. He also brings the perspective of being a representative for our region. So we are truly honored and privileged to have him bringing that valuable information. We hope to, quote unquote, see you all Thursday at 3 for our next webinar. Thank you and have a great evening.
Thanks, everyone. Have a good night.